Hello and welcome to our Lunch and Learn SEC Proposes Climate-Related Disclosures Part 2. Before our webinar begins today, I would like to go over a few housekeeping items. In case you do not know, you can earn 1 CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least 3 of our interactive questions. You will receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. We also invite you to complete the course evaluation that will occur at the end of the webinar. We appreciate any feedback that you give us. I will now pass it over to our speaker, Amy Ripepi, for the second of her 2-part series on the SEC proposals for climate-related disclosures. Over to you, Amy.
Thanks, Sharon. Welcome to everybody. Several weeks ago, we talked about the SEC's proposal on climate-related risks. Today, what we're going to talk about is the feedback that the SEC received on its proposal. If you take away only 4 message points from our discussion, it would be these, the ones that are on your screen. First is that the SEC received overwhelming interest in its proposal, over 14,000 comment letters. Second is that the business community does have concerns about the scope of the proposal and the cost of implementing it. Those shouldn't be a surprise if you've taken a look at the proposal, and we'll go through some of those concerns in more details, but that's certainly a takeaway point. Another takeaway point is that investors were pleased that the SEC had released the proposal, but they too have some concerns, and as you'll see, many of those concerns overlap with those of the business community. And finally, there are numerous issues on the one topic that is probably of most interest to accounting and finance personnel, and that is the proposed metrics that would go into the financial statements. So with that, let me talk about the agenda. I'm going to start by giving you a brief refresher on what the proposal would actually require. I'll spend the bulk of the time then going through the feedback. And I'm going to focus the feedback on the comments from the business community and what I'm going to call the institutional investor community. Those to me are the SEC's 2 key constituents, the folks who are looking to obtain capital and the folks who are looking to provide capital. I'll wrap up by talking about next steps, and stay tuned because I'm going to give you some predictions. And then I'm going to turn it over to Matt, and he will talk about some of the additional resources in CCH's Accounting Research Manager, one of which should be my upcoming gap update, which will deal with the SEC's feedback in more detail. That'll be in the August 15th, 2022 issue. Now, for your first polling question, do you currently subscribe to an accounting research service? Yes, I do, and that's a subscription to CCH's Accounting Research Manager. Yes, I subscribe, but to another research service. And the third option is no, I don't have a subscription to an accounting research service. While you're filling that out, I'll begin talking about my next section, which is a brief refresher on what the proposal would require. I'm going to stay at a very high level, just enough to remind you of the principal elements of the proposal and the terminology. For those of you that are very familiar with the proposal, please bear with me, but I think it helps to set the stage for what the feedback is going to be addressing. An overview of the proposed disclosures would be grouped into 2 logical buckets, the qualitative information and the quantitative information. Qualitative includes climate-related risks, i.e. how management plans to address those via governance, risk management, strategy, and targets. Then there are the 2 areas of quantitative disclosures, and those would be greenhouse gas emissions and climate-related expenditures. Let me talk about the who, where, what, and when of these proposed disclosures. The proposal would apply to all public companies, and I'm pretty certain it's just about all. Domestic public companies, foreign public companies, smaller reporting companies, non-accelerated filers, business development companies, companies that are planning to do an IPO, emerging growth companies. If you're on that list, you would be required to comply with these disclosures if it were finalized as proposed. The only exempt group would be asset-backed issuers. Where would the disclosures be presented? In routine filings with the SEC, such as registration statements on Form S1 and S3, and annual reports like your Form 10K. The what includes the following. First of all, you would deal with governance, including any governance aspects that you have put in place. Do you have any board committees that are dealing with climate-related disclosures? Do you have a board member who's an expert in climate-related risks? You would talk about your physical and transition risks that are, and I'm quoting here from the proposal, reasonably likely to have a material impact over the short, medium, and long term. And the definitions of those time horizons would be completely up to you. If you consider 2 years to be short term and 5 years to be medium term and 10 years to be long term, that would be the basis upon which you would analyze your physical and transition risks. If you think short term is 5 years, medium is 10, and long term is 20, then that would be the time horizon that you would focus on. You would talk about your risk management, including whatever processes and transition plans you might have in place, your strategy and any analytical tools that you would be using, such as scenario analysis, to help you address these risks. The what would also continue qualitative information about any targets and goals that you may have set internally or that may be imposed on you by regulation, law, treaty, industry affiliation. And an example of a target or goal would be something like, we're going to achieve net zero by 2030. The quantitative information would be in 2 buckets. The greenhouse gas emissions metrics, try and say that quickly several times. That would be scope 1 and scope 2. All companies will be required to provide that information along with the related intensity data. Scope 3 emissions metrics would be required only if they are material or if the company has set a target that includes scope 3 as part of that target. Accelerated and large accelerated filers would provide an assurance report, and by that I mean essentially an audit report, on the scope 1 and scope 2 emissions data. Other companies would not be required to provide an assurance report, and no assurance would be required on any scope 3 emissions data that's disclosed. Last but not least, in the financial statements, companies would disclose the climate-related financial effects. That includes the cost and the financial impact related to severe weather events and any transition activities. The disclosure threshold would be if those amounts exceed 1%, yes, I did say 1% of any line item on the financial statements. And because that information is in the footnotes to the financial statements, it would be covered by the audit opinion and internal controls over financial reporting. Now, I just used a whole bunch of jargon, so before we go any further, let me offer you a cheat sheet that I used in my last presentation. The SEC's proposal includes a definition of climate-related risks. You've noticed that I haven't used the phrase climate change because that's not what the proposal focuses on. It focuses on the actual or potential negative effects of climate-related conditions and events on the financial statements, the company's operations, or its value chains taken as a whole. That's what the disclosures focus on. In terms of greenhouse gas emissions, greenhouse gases are, in plain English, gases that trap heat in the atmosphere, thus making the earth warmer. It includes things that you've heard about like carbon dioxide, methane, and nitrous oxide. And it also includes 4 fluorinated gases. Those are compound gases that come almost exclusively from human-related activities. Last but not least, you'll hear me refer to transition plan and transition activities. These are also terms that are used in the proposal, and those refer to things that the company is thinking about doing or actually implementing in order to manage its climate-related risks. It could be anything from replacing light bulbs with more efficient types of lighting devices. It could be converting your fleet of vehicles from gas and diesel to hybrid or electric. It could be redesigning your products or your manufacturing processes or identifying different vendors or suppliers. All of those things would be transition-related plans or activities that are related to climate-related risks. So before we move on to the feedback, which will be the bulk of the presentation, I want to ask you one more polling question. I just gave you the answer, so here's the question. Which of the following is considered a greenhouse gas? Krypton, helium, nitrogen, methane, or all of the above? A quick trivia note for those who are familiar with the DC Comics superhero Superman. Kryptonite is not derived from krypton, nor is krypton derived from kryptonite. Krypton is a colorless, naturally occurring gas, which was discovered in 1898 by a British scientist. Kryptonite first entered the DC Comics in about the 1940s. So while krypton is a colorless gas, kryptonite is the one material that is a rock-like substance that can prevent Superman from leaping tall buildings in a single bound. Let's move on to feedback, and I'm going to start with who the SEC is actually hearing from regarding its proposal. Like I said, the feedback was overwhelming, more than 14,000 comments in total. And because context counts, one of the more important concept releases that the SEC has issued in the past several years was one dealing with Form 10Q and earnings releases, where the SEC was thinking about completely revamping its requirements for those. And even on a topic that would seem as important as that, it only received 70 comment letters. So 14,000 is pretty overwhelming. The comments, when you get 14,000 of them, are going to be very diverse. I focused principally on letters from businesses and what I'll call institutional investors. I also looked mostly at issues that I think are relative to accounting and finance professionals. There are various letters that raise legal questions. I'm not skilled at that area, so while I read them because they're interesting, that was not my focus. And what I found in looking at my sample of letters is that there were several common themes. One was, should the SEC be setting any rules at all? Another was materiality. Does the proposal really focus on things that are material? Another focus was on the requirement for disclosures about greenhouse gas emissions. Another very popular topic was the proposed footnote disclosure on climate-related expenditures. And of course, companies and investors also commented on the proposal to have some level of assurance on that quantitative information. Now, while I want to drill down on exactly what the feedback was, I do want to provide a little bit more color commentary on exactly who these constituents were that provided feedback. I said there were 14,000 letters in total. That's true. 10,000 of those came in the form of form letters. There were about 28 different templates that usually individuals or small groups of individuals would fill out and send to the SEC. That leaves approximately 4,000 unique letters, of which most of those came from individual investors or, as I said, very small groups of individual investors. The remaining 1,000 came from the following groups: the corporate sector, institutional investors, professions like accountancy and lawyers, special interest groups, think tanks, politicians, and then a potpourri of others like stock exchanges and accreditation groups. So a very, very wide range of input. Let me give you some of the examples of names that you'll be familiar with from both the corporate sector and what I'm calling institutional investors and investment advisors. Some of the corporate letters came from GM, Dow, ExxonMobil, Walmart, Tyson Foods, United Airlines, UPS, Bank of America, Occidental Petroleum, eBay, Alphabet, the U.S. Chamber of Commerce, FEI, and trade groups like the American Bankers Association. Investors included Fidelity, BlackRock, Morningstar, CalPERS, the Credit Roundtable, PIMCO, the Council of Institutional Investors. And I focus principally on the institutional investor community because the individual investor letters were generally very cryptic and to the point. Yes, we support the proposal. No, we don't. And I was interested in more analytical input from the groups, and so that's why I have subdivided them and focused principally on the institutional investors. So let's now talk about exactly what they said. And let me start with what I think the threshold question is. Should the SEC be engaging in rulemaking as it relates to climate-related risks? Now, you've probably seen some headlines. For example, one recent headline was, "Companies skewer SEC's climate disclosure plan." Another referred to corporate backlash over the SEC's proposal. But in my view, those headlines don't really tell the whole story. The threshold question of whether the SEC should be setting any rules at all was not unanimously agreed to by the corporate community. There were certainly those who think that the existing rules are perfectly adequate and nothing further is needed. But quite frankly, the majority of the corporate community supports rulemaking. This quote on your slide comes from the letter of a Fortune 100 company who wrote, "Standard reporting practices not only provide more comparable disclosures for investors, but also provide registrants with overall cost savings in the long term." Now, just because they support rulemaking doesn't mean that they were applauding this specific proposal. Their support for rules comes with caveats. They want rules that are principles-based, that are guided by materiality. They want a well-crafted rule that allows companies to report on the risks that they view as the most important. They want rules that strike an appropriate balance. In terms of the investment community, the investors, they definitely support rulemaking. Their views are that they need information that's comparable, it's consistent, it closes the gap between the information that they need and the information that some companies are willing to provide. And they want information that they can rely on, that they feel confident has some degree of credibility behind it. However, like the corporate community, they're not without criticisms. And you will find, as I talk further, that some of their criticisms of the rules are actually quite similar with those of the business community. If I had to pick one topic that was sort of the overarching criticism, it was that of materiality. Many believe that the proposed rules are too granular, that they're not sufficiently grounded in the long-standing definition of materiality under securities laws. Under securities laws, as basically codified by Supreme Court rulings over the decades, material means a substantial likelihood that the fact would have been viewed by a reasonable investor as having altered the total mix of information available. The corporate sector believes that what the SEC has proposed are prescriptive rules that are unduly burdensome and that don't allow companies the flexibility to provide disclosures that they believe are meaningful. And frankly, some investors agree. They believe that the goal should be meaningful information that doesn't overwhelm investors or, as one institutional investor wrote, worse, obscuring their focus from more significant disclosures. And they're not just talking about the more significant climate-related disclosures, they're talking about all disclosures. If you put too much weight on one topic, it detracts from the significance of other topics. And if you've taken a look at the rules, or as we go through, as we talk about them a little bit more, you'll realize that these rules, as they've been proposed, are not written like the rules for risk factor disclosures or MD&A. They are written in very prescriptive, granular terms. So what did these two groups say about the qualitative disclosures about climate-related risks? Keep in mind that this is the category that talks about governance, risk management, a company's strategy, its transition plans, and its targets. The corporate views are that these proposed rules are far too prescriptive, that it goes into way too much detail, and that it often, by its formulation, discourages companies from developing transition plans and scenario analysis. Because what the proposal says is that if you have transition plans, if you prepare scenario analysis, you should disclose those as part of your climate-related risk disclosures. Therefore, companies that don't currently have these plans or currently prepare scenario analysis would perhaps second guess whether or not they should do so if they know that with that comes a disclosure obligation. Another observation was that, for example, some of the specific risk disclosures are way too granular. One of the SEC's proposals is that a company that has locations that have a significant physical risk, i.e. has had or is likely to have a material impact on the company's business or financial statements by virtue of its location in an area that is exposed to significant climate-related risk, is that they would have to identify that by zip code. And as you can imagine, the corporate view was that that's far too granular. Another example of criticism on this topic of climate-related risks is that while it's nice for the SEC to say, define short, medium, and long-term on your own, whatever you think those terms mean, that's how you should provide your disclosures. Many businesses thought that even within industries, that would lead to a lot of non-comparability, that you might end up with very different disclosures and very different information content depending on how any one individual company defined those terms, and that it would be helpful for the SEC to clarify what it means by each of those. Some even suggested that we don't really need a medium-term category, that we could just boil it down to short-term and long-term, since that's really how most companies think about most of the information that they put together, what's going to happen in the short term and what's going to happen over the longer term. On the investment community side, they were mostly positive about these qualitative disclosures, although they too agreed that some of the rules are overly prescriptive. Some of them agreed that the rules might actually discourage transition plans and scenario analysis, and suggested that the SEC not require that information, but make it voluntary. On the flip side, some investors said that those specific data points, that specific type of information, is singularly important. So it'll be interesting to see what the SEC does with that kind of conflict in the viewpoints of different investors. Now let's move on and talk about some of the quantitative disclosure requirements. First, I'm going to talk about greenhouse gas emissions. Recall that the proposal would ask for companies to disclose Scope 1 and Scope 2 emissions. Scope 1 being the direct emissions, the ones that are produced by your factory. Scope 2 being your indirect emissions, the ones that are produced by virtue of your consumption of electricity and your use of energy. Those would be required for all companies. Scope 3 under the proposal would only be required if it was material or if it was included in a company's target. For example, if the company's net zero by 2030 target included its Scope 3 emissions. And under the proposal, this information, these metrics would be disclosed by gas. There are 7 greenhouse gases, the 3 discrete ones I mentioned earlier, and then the 4 fluorinated ones that I didn't describe in any detail. So let's talk about these in 2 buckets. Scope 1 and Scope 2, those requirements generally got support, both from the business community and the investor community. One of the issues, though, that the business community raised was the question of organizational boundaries. So if you tell me that Scope 1 and Scope 2 are for my indirect and direct emissions, and my direct emissions are from properties that I own or I control, what exactly does that mean? Because in the proposal, it says it means whatever is included in your consolidated financial statements. However, if you look at the greenhouse gas protocol, what you'll find is that they don't use financial statement organization to define those boundaries. They use a different approach. So let's take a leased airplane, for example. You lease a corporate jet. For financial statement purposes, you have an asset on your books, the rights to the use of that airplane. So under the proposal, you would have to include those emissions as in scope 1. Any emissions would be under scope 1 because it's an asset that you, quote, own or control by virtue of its inclusion in your financial statements. But that's not how companies generally are preparing scope 1 and scope 2 emissions currently. Another example of organizational boundaries would be equity method investees, variable interest entities, and for companies that prepare financial statements under IFRS, because foreign registrants are covered by this, the use of proportional consolidation, which is accepted under IFRS. Those would be part of the scope 1 and scope 2 for purposes of this proposed disclosure, but currently that's not how companies are gathering the information. So that was one fine point that many companies raised in their comment letters to the SEC. But setting aside that definitional issue, which I think would be relatively easy for the SEC to resolve, there really weren't concerns about the requirement to disclose these two categories of emissions. On scope 3, however, there is absolutely no common theme that I could find, not among businesses and not among investors. The views are quite frankly all over the map. To my surprise, to be honest, some companies wanted scope 3 to be mandatory for all companies. In their view, that data is accessible, and yes, it requires estimates and judgments, but those are no different from any other estimates or judgments that companies use. There are tools out there to gather the data, and it should be required because, in their view, it's important and it is material. On the flip side, there are those who suggested that scope 3 should not be required, that it's far too premature, that the data is still too raw, it's still too unreliable, the tools are still too difficult to use and sometimes not used properly. And so therefore, if the SEC is going to require it from anybody, it needs to wait until we get some more consensus around the development of scope 3 information. Just wait. And then there's everything in between. So it's difficult for me to say what the SEC is going to do with that. There was also a lot of confusion over what the SEC means under the proposal by the word material in this context. Because recall, the rule says disclose scope 3 if it's material or if you include it in one of your targets. So what does material mean? Does it mean material to a reasonable investor? That broad definition that the SEC has long used for defining materiality. Does it mean material to total emissions? Does it mean whether the level of scope 3 emissions exposes the company to material financial risk? What exactly does the SEC mean when it refers to scope 3 as being material? So even if the SEC were to go forward with its current proposal, i.e. if material or if included in a target, companies are looking for help in determining what it would mean to define that as material. Now let's spend a fair bit of time on the footnote disclosures, because this is the information that we accountants and finance professionals have the most responsibility for. And if it's going to go in the footnotes, it's going to be audited, and that's going to subject it to a lot of scrutiny. I'm going to start with a schematic that I included in the last webinar. There are 4 categories of disclosure under the proposal. Each category has to be identified and quantified, and the materiality is based on 1% threshold for each of these, 1% of any line item. So whether the line item is revenues or cost of sales, whether that line item is plant and equipment on the balance sheet, whether it's other income and expense or interest expense, it's a 1% disclosure threshold for each line item for each of these items individually. So what are these four categories? I gave you some examples. So they are a severe weather, or other natural condition. It could be a financial impact, or it could be an expenditure. An example of a financial impact would be a $5 million impairment charge for an asset that's damaged by severe weather. If that $5 million impact exceeded 1% of whatever line item the company reports impairment charges in, then that would have to be disclosed. An expenditure would be, for example, $750,000 to move an asset to a less risky location. It's in a location that is at high risk because of other natural conditions like drought or changes in sea level, and the company is going to spend $750,000 to move it to another location that is less risky. That would be an example of an expenditure. And so if that $750,000 exceeded 1% of whatever line item it's included in, it would be disclosed. Those are two categories. The two other categories relate to transition activities. And recall that transition activities relate to the company's plans to deal with climate-related risks. So for example, if a company raised money with a bond that has climate-linked conditions such that the failure to achieve a particular metric like greenhouse gas emissions would change interest expense, that would be a financial impact of a transition activity. The transition plan is to minimize greenhouse gas emissions, and the failure to do that increased interest expense. So if that $400,000 in my example exceeded 1% of interest expense, then it would require discrete disclosure in the footnotes to the financial statements. An example of a transition activity expenditure would be, for example, a capital expenditure, something that would be capitalized rather than expensed. It could include an asset purchase that was made in order to reduce greenhouse gas emissions. So all of this is a refresher on what the proposal requires. So now let's talk about what companies said in response to the proposal. As you can imagine, the business community strongly objected to this aspect of the proposal. I honestly cannot think of a letter that I read that was from any aspect of the business community that didn't raise some concern about either the threshold of 1% or the operationality and definitions that the SEC was using in order to explain what it was that it wanted disclosed in the footnotes. There was almost unanimous agreement that the 1% threshold is burdensome and that, quite frankly, it leads to meaningless data. As one company pointed out, it places a disproportionate lens on impacts related to climate above all other material impacts to a company and its financial statements. We don't use a 1% disclosure threshold for just about anything else. Now, the SEC rests its choice of the 1% based on excise taxes, a long-standing disclosure requirement in Regulation SX that deals with excise taxes that exceed 1% of the revenue line item. That's the basis upon which they drew the 1%. But that's pretty narrow, and excise taxes are unbelievably easy to isolate in the financial statements. Furthermore, the revenue line item, for most companies at least, is usually the largest line item. So 1% of that line item isn't going to trigger a lot of disclosure, and when it does, it's going to trigger disclosure of something that's very easily identified, defined, and captured in the normal course of financial reporting. This is very different from that. The business community also raised concern about the definitions of the terms that the SEC used, like severe weather and other climate-related conditions, And they pointed out that the measures that the SEC is asking for are highly judgmental and would require numerous allocations and estimates. As one letter pointed out, it risks confusion among investors who may equate the level of detail, i.e. this 1%, with a level of precision that is not consistent with the nature of the disclosures. When I gave you my 4 examples in that previous slide of the various categories of disclosure, I made them really simple and really easy. But in reality, they will be very difficult to identify. And as we will talk on the next slide, your ability to come up with that information is going to require numerous policies and procedures to first identify the events, and then second, figure out exactly which costs to capture and how to allocate certain things that you don't normally ascribe to a lot of these events. On the investor side, frankly, many investors didn't comment on this at all. They just seemed to either accept that it was good information or assume that they understood what was being asked for. However, several investors did agree with the corporate community. As I say in the slide, one investor wrote, "For the time being, the SEC should dispense with this rule in favor of a more principles-based approach for reporting any financial statement metrics." And of no surprise to anyone, I think, is the fact that many believe that what we currently have under US GAAP, when you look at all the various disclosure requirements and how they affect all the various line items, and then you match that up with what's required currently under MD&A, many believe that our current rules are already designed to capture the very significant things that may arise as a result of climate-related risks, whether they are immediate because the company suffered a loss, or whether they are ongoing, something that the company needs to talk about as a known trend or uncertainty, as is requirement under the MD&A rules. So what kinds of operational issues did companies raise? The US GAAP update service that I author every couple weeks is coming out on August 15th with an issue that's dedicated to the feedback that the SEC received on this proposal. And I spend a fair bit of time talking about some of the operational issues that were raised. On this slide, I've tried to capture a handful. One question is, okay, you've told us that you want disclosure of severe weather events. Well, how exactly should we determine the severity of a hurricane or any other weather event? Should we assess it based on wind speed, human casualties, the economic impact on the geographic area? Is it severe based on its impact financially on the company? Or maybe perhaps all hurricanes are severe just by definition. They're not just a tropical storm, they've risen to the level of a hurricane, therefore they must be severe because they are a hurricane. Or maybe it's just those that reach a certain category, maybe a category 4 or a category 5. So how exactly should we determine whether a weather event is severe or not? Another type of question, what triggers disclosure for financial effects that of natural conditions that are chronic? Okay, so a hurricane, that's a discrete acute event. We know when that event occurs, but it says other natural conditions. Those could be chronic conditions such as a rise in sea level, a rise in temperature. What triggers disclosure of the financial effects of those? Does it have to rise to the level of something like is happening in England right now where tarmacs are melting? Or is it something else? Another thread that came up was how do you deal with financial impacts as the SEC talks about them? Now, the proposal says that the financial impact would be, and I'm quoting, derived from existing financial statement line items. It says derived. And the example that they give includes a severe weather event like a hurricane that disrupts revenues from a business. And the disruption to revenues would be a financial impact of that severe weather event. So the question is, How do you measure the impact on changes to revenues? Is it changes from the last quarter? Is it changes from your forecast? Does that make it a non-GAAP measure? Does that make it a pro forma amount? Let's talk about some of the other operational questions. So a transition activity, those are things that are intended to reduce your greenhouse gas emissions. What if you just have routine replacement of old vehicles? And the routine replacement necessarily means that the capital expenditures are for vehicles that are more energy efficient. You couldn't possibly buy a vehicle that's as energy inefficient as the ones that used to be in your fleet. Is that kind of routine replacement of old vehicles a transition activity, even if it's just occurring in the normal course? What about a hurricane that damages a warehouse? You build a new one, and that new one uses renewable energy. Now, the hurricane damaged the warehouse. So is the rebuilding of that a severe weather event impact? But you're using renewable energy. So that sounds like a transition activity. So what is this? Is this rebuilding of the warehouse a severe weather event or a transition activity, or is it both? Now let's use another common question. You have a vehicle fleet. You converted from gas to electric. You have to isolate the cost of the transition activity. Is the cost of the whole fleet? Is it the incremental cost? Because you could have gotten more efficient gas vehicles, but you went to electric. So is it the incremental cost of what going to electric requires? And then what do you do about the fuel differential, the fact that your electric bills are going to be different now that you're using electricity, and that's hopefully going to cost you less than the gasoline that you used to purchase. And then what about depreciation? Is that also a transition activity that has to be captured in this data? So these questions, in my mind, are just the tip of the iceberg, and it shows how difficult it is to understand how we would implement what the SEC has proposed as written in its draft document. But before we continue, it's time for another polling question. What is the proposed bright line threshold for disclosing climate-related expenditures? Is it 20%, 10%, 5%, or 1%? This is the bright line threshold for, under the proposal, for putting climate-related expenditures into the notes of the audited financial statements. The final section I want to talk about in terms of feedback relates to assurance, and then a potpourri of other common comments. As you'll recall, the proposal would ask for assurance reports, reasonable assurance reports, which is essentially equivalent to an audit opinion, on Scope 1 and Scope 2 greenhouse gas emissions from accelerated filers and large accelerated filers. Other companies would not be required to provide any kind of assurance report. That would be phased in. It would start out with limited assurance first and then eventually get to reasonable assurance. But the ultimate goal would be reasonable assurance on those two data points that would be in the outside of the financial statements. You would also get assurance if you were an investor on climate-related expenditures because those would be in the notes to the financial statements. And I don't think anybody's going to be surprised about what kind of feedback the SEC received on this. The business community generally does not support this. They don't support either the assurance reports on Scope 1 and Scope 2 or the inclusion of climate-related expenditures in the footnotes to the financial statements. They observe that if the SEC is going to require these kinds of climate-related expenditures to be disclosed, that they should be outside the financial statements, either in some unaudited supplemental schedules or in MD&A. They also point out that while the SEC attempted to estimate the cost of obtaining these kinds of reports, that in their view, based on their experience to date in obtaining these kinds of assurance reports, the SEC has significantly underestimated the cost of obtaining these, particularly because there aren't a lot of vendors providing these kinds of services. So as you're ramping up, there's going to be a lot of competition for getting some kind of report from somebody, and therefore that's going to ratchet up the cost until the market sort of settles down. On the investor side, not surprisingly, investors view this as important. Some observed that they would be okay with limited assurance on the emissions data, but others went on to say, we actually want assurance on all companies. And some went so far as to say, this data is so important to us, and we're so concerned about greenwashing that we want assurance on all emissions that are disclosed. One of the investment firm letters that I read actually suggested deferring any kind of requirement until the markets kind of settle down, companies get more familiar with actually disclosing this information, and companies get a chance to identify auditors and qualified firms, et cetera, and do some dry runs of getting assurance reports before actually requiring this kind of reporting in the future. And then a potpourri of other kinds of comments that I think are relevant to the financial reporting community. Many companies asked for a longer timeline for a phase-in of the new rules. The proposal is phased in, giving smaller companies a longer period of time to implement the disclosure requirements. But many companies asked for more time. Initially, when you first adopt the disclosures, the proposal would say that you have to provide comparative data. And many said that this would be very burdensome and very onerous. Could you please exempt comparative data at the time of implementation? We'll give you the current year, but not prior year. And obviously, eventually over time, you'll get trend analysis. Several in the business community asked that the deadline for filing the climate data be decoupled from the 10K deadline. As proposed, all of the disclosures that I just talked about would be required concurrently with whatever your 10K deadline is. And if you're a large accelerated filer, that's pretty quick. So several suggested, for example, could you give us 180 days after the normal 10K deadline or the end of our year to file that information? Because it's going to take us time to gather all this information and make sure it meets all the required rules. Several asked for furnish rather than file, which subjects the information to a lower level of liability. Several asked for different kinds of organizations to be exempt from the disclosures, like business development companies and REITs. And many asked for some more exemptions or exceptions for smaller reporting companies. So let me wrap up in my final few minutes before I turn it over to Matt with some next steps. And here's where I'm going to pull out my crystal ball. Now I'm going to grade myself. I gave you a prediction in the last seminar, which was that based on my reading of the proposal, I fully expected significant pushback as well as significant support. And I think I did okay with that prediction. There definitely is significant pushback, as we've talked. But there is also significant support, principally from the investor community, but also from the business community for the idea of some body of rules, some set of standards that on a principles basis would allow companies to move forward, providing investors with the information they need in a credible, consistent, and reliable fashion. This seminar, my prediction is that we should expect many changes, but we should also expect some new rules. So how confident do I feel about that, and sort of how did I come up with that? Well, I think the SEC basically has three options. It can issue the rule exactly as it is. It can issue no rule at all. Just put this on the back burner and wait until another day. That has happened in the past. The SEC has oftentimes issued a rule proposal and then decided that it was, for whatever reason, not necessary, not appropriate to move forward with a rule. That is an option. And then the third option is to make changes and issue a rule. Those are the three possible courses of action. I think issuing a rule as is highly unlikely. Now, I could be wrong, but my many years of watching the SEC, I find them, regardless of the administration in charge at the time, that the SEC is very responsive to the feedback that it gets. And when it gets constructive feedback, as I think many of the points are that the SEC is receiving, I think it will act on that constructive feedback. And therefore, I do believe that in certain key areas, such as the question of materiality, being more principles-based, being more consistent with the use of the term materiality, I think for scope 3, the SEC is probably going to reconsider that. And I also think that on the climate-related expenditures, I think the SEC will reconsider that. I don't think it's going to issue the rule as it is. The other option is to issue no rule at all. There is unquestionably political pressure on this issue. I haven't raised it because it wasn't the focus of my presentation, but there absolutely is a lot of political pressure. And if you take a look at a handful of the letters that were written by political groups, you will see that both sides are very firm in their views. And there are legal issues that are being raised by various groups, with groups of attorneys and academics writing on both sides of the, is this a violation of the First Amendment question? So it would be possible for the SEC to issue no rule at all. That said, the SEC has been pushing for climate-related disclosures for more than 12 years. Back in 2010, it issued an interpretive release calling for companies to do a better job under the existing rules of dealing with these disclosures. And what has happened? It's gotten more information in SEC filings, but they've been boilerplate. And they are, quite frankly, wildly inconsistent. And more often than not, what's in the SEC filing bears no resemblance to what is in other information that these companies publish on their website, which begs the question of, if it's important enough to put on your website, why is it not material enough to disclose to your investors in an SEC filing? So the status quo, I think, is just not tenable. So therefore, I think it's pretty easy to come to the conclusion that they will make some changes and they will issue a rule. And in terms of the nature of changes, I think I'm pretty safe in saying that I think they will deal with the issue of materiality. I think I'm safe in saying that they will deal with scope 3. And I think I'm safe in saying that they will make substantive changes to their current proposal on climate-related expenditures in the financial statement footnotes. Now, some suggested to the SEC that maybe they should let the FASB deal with that. That's certainly an option. The SEC has long deferred to the Financial Accounting Standards Board for determining what information is relevant to investors for inclusion in public company filings in the financial statements. The SEC, however, has the legal statutory right to set whatever financial statement requirements it deems important. And it has often, over its history, done something other than what is required in GAAP. So they have the right to ask for more, but as many companies have pointed out, you've long deferred to the FASB. They have a solid process with a lot of due process that wraps in views from many important constituencies. Why not follow that course of action rather than coming up with something on your own? So again, I think these are some of the areas in which the SEC is likely to make a change. The one area I'm unwilling to make a prediction on is timing. Now, many were thinking that the SEC would issue a rule before the end of the year. That's certainly possible. I'm unwilling to give you a prediction on that one. So hold me accountable for these other predictions, but I'm not going to offer one on timing. And with that, I am going to turn it over to Matt.
Thanks, Amy. I'm going to go ahead and show my screen here. Hopefully everyone can see my screen. So I am the lead product manager for our accounting and auditing flagship product for research called CCH Accounting Research Manager. I've been with CCH for on and off almost 20 years now. So my specialty is in the accounting and audit space for the company. My email address is down below. It's matthew.sigmiller@wolterskluwer.com. So if there's any questions or any type of information you want to gather for Accounting Research Manager or in regards to this presentation, I'd be more than happy to entertain your questions through email. So we've just got one last polling question, and then I'm going to actually jump into the CCH Accounting Research Manager solution and show you a few things on how you can do searches, how you can actually go into the 10K lookup and actually pull up 10K and 10Q filings through the SEC based on publicly traded companies. But once again, this quick polling question, if you would like a demo, we can actually set that up for Accounting Research Manager. So simply, if you could, answer yes or no, and based off your response, we will follow up accordingly. So I'll go ahead and close out of this and actually jump into the Accounting Research Manager screen here. This is actually the main homepage of the service. We break it down, it's really easy and clean to use. We break it down really into 4 different sets. The accounting area, which is here at the top, which includes the FASB codification, the accounting standards themselves, our ARM editorial staff interpretations and examples of those accounting standards. And then down below, we've got the secondary box, which is the SEC regulatory content. So all our SEC practice information, PCAOB coverage, financial statement requirements, financial statement disclosure information. That's all found here in the middle box for SEC. On to auditing. We do an excellent job with not only the AICPA coverage and PCAOB auditing standards, but also our interpretations and analysis of those standards from those standard setting bodies. The last piece really involves the add-on solutions that we have for Accounting Research Manager, which is our internal controls piece. So if it's fraud or forensic type information you need, practice aids checklist, that's all covered in internal controls. And then obviously the governmental. So governmental GAAP and that type of coverage would be included in here, as well as our practice aids and those types of disclosures manuals. So I'm just going to go ahead. I know we've got only a few minutes time, but I'm going to go ahead and do a couple sample searches based off of some of the information that Amy provided to us earlier. So for example, if I wanted to do a keyword search just on greenhouse gases, all I would need to do is type in, I could type in the acro or I could type in the full name, it really doesn't matter. I'm going to go ahead and type in GHG for greenhouse gas emissions, and you're going to see your results. Now from here, I could actually do a keyword search within this search results to kind of narrow it down. If I wanted to find scope 2 versus scope 1 or 3, I could do so right here in this box. It also breaks it down by the type of content that you want to receive back. So whether it's information from our audit and accounting guides, whether it's just authoritative information, or whether it's our actual ARM editorial interpretations and examples, those analysis could be found here as well. And you'll see the number that denotes how many hits came back in that particular area. But I'm just going to go ahead. I'm going to click on one of these because obviously we talked about a lot of proposed SEC information today. So I'm just going to go ahead and click on this one just so you get a good feel for the type of content and what it looks like on the screen. This has to deal with the standardization of climate-related disclosures for investors. So I can go through and look at scope 1 and 2. It actually breaks it down. Once again, Amy kind of covered some of this, you know, in the fiscal years 2 and 3, limited assurance, reasonable, and there's fiscal filing dates too as well. So you'll see here everywhere highlighted in yellow is where it actually performed the keyword search based on our search engine results that we typed in. Within the body of this proposed document, you're also going to see links or footnotes to other source documents. Now, if there's an icon next to it, that's actually going to be a hyperlink. So throughout Accounting Research Manager, there's a ton of hyperlink text documents that will allow you to go in from a proposed document, from authoritative body over to our explanations, which is our CCH editorial analysis of the issue. So once again, that includes real world examples and other types of planning or practice notes that might be included in there from our ARM editorial staff. And you'll see that's denoted here. We're in a proposal document. It's actually flagged. So every document is clearly flagged with the information telling you whether it's an SEC document, a FASB document, or whether it's our interpretive document from our ARM editorial staff. So I'm just going to go ahead. I'm going to go back to the main screen here, because I know we're right at that time. One other thing I did want to point out is we've got a closer look, which is our PDF white papers, if you will, to the related disclosure proposal, information that Amy had just spoke about the last 55 minutes. So we've got a lot of good analysis coverage in here based on those client-related risks, client-related expenditures, what it means to the financial statements for publicly traded companies. This is a really good piece, so I would definitely invite you to take a look at it. This is something we could offer to you free of charge to take a look at this downloaded white paper. So feel free to go ahead and get a hold of me as well with any questions. And based on that, I will go ahead and send it back to Sharon.
Thanks, Matt, for the demonstration of CCH Account Research Manager, and a thank you to our speaker, Amy, for a great informative presentation. For anyone who answered at least 3 of the required polling questions and stayed connected to the entire webcast, you can expect to receive an email within 2 to 4 business days with instructions on how to access your CPE certificate. Please note the instructions will be sent to the email you used to enroll for today's event. Thank you all for attending our July Lunch and Learn, and we will see you at the next time. Have a good one, everyone. This concludes the webinar.